Sunday. It is so amazing to see the hall packed here today, so early in the morning. On behalf of AFG and our president, Dr. Nitin Shah, I extend a warm welcome to all the first-time finance enthusiasts and all the Wealthconians. So I think this program today is absolute efforts from our president, Dr. Nitin Shah sir. His, mission of this year was financial freedom for everybody. And I think this program is like a fantastic end to his year. He's made sure that all of us will achieve financial freedom. And this program has come before the end of the financial year. So definitely we still have some time for this year to start our investments. So I would welcome Dr. Nitin Shah sir to just give a sort of a brief for this program. Nitin sir.
So thank you very much. I welcome you all this on the Sunday morning and making our day so successful. As I took over as a president, it was a vision to give back to the society, not only in form of gynec academics, but to have a lively entire year to celebrate, have fun, come together, and we tried to plan all the programs meticulously, and I think because of your support, it all went very nicely. And today we thought of what can we break AFG into, and struck to my mind achieve financial Gyan. And I thought the finance in today's world is very important. As you know, yesterday there is again an Israel war, and we have faced already COVID-like situation where we have to sit home, we can't practice, we can't go to the hospital, and I think many of the doctors have income standstill, and we should have an alternative source of income, how we can survive if our primary income goes to some toss, So this is always helpful, and none other than Dr. Ramnath Guthe, founder of the Wealthcon. And I think my friend Dr. Santosh Jayabhai was after my life, join Wealthcon. And he brainwashed me in Egypt for 2 hours on Nile cruise, and I was reluctant to join Wealthcon. कि जाने देना यार अपना practice में बहुत है, we don't want something like. But then COVID struck, and there was a first online program of Wealthcon which I attended, and it had changed my entire perception. Those who are in touch with me, I know means they know how it is helpful in many ways, not only in finance, but other aspect of life also it has touched a lot. Like we have started Healthcon activity, and I was able to submit Everest Base Camp, okay, which is 18,000 feet above sea level. It was not a joke, but just because doing such activities has boosted us our morale. So today, I welcome you all for this financial knowledge awareness. Thank you.
So thank you so much, sir, for not gatekeeping this. In fact, the first time I actually heard about Wealthcon was from sir's messages only. So thank you so much. So let's begin our session. I would like to welcome our chairpersons for the session, Dr. Vidya Bandhukwala. She is a director of Touch of Joy Women's Clinic and Fertility Center, managing committee member of AFG, and the founder member of the Female Pelvic Pain Association. And Dr. Kausha Shah. She is a consultant at KK Specialty Hospital and KK Medical Center, Dahisar. She is a grade 1 consultant, a DNB grade 1 consultant at BBDA Hospital, Kandivali, and she is a MUH recognized undergraduate teacher. So we welcome you all. Over to you.
Good morning, everyone. So can I start, sir?
A small introduction for Dr. Sanket Prasad. Sir is a well-known endoscopic surgeon, is a recipient of multiple awards in OBGY, and has devised innovations like the Prasad's vasopressor injection needle and the shoelace knot. We welcome you, sir, and await your lecture. Yes.
Thank you so much, chairpersons. At the outset, I'd like to thank AFG and Dr. Nitin Shah for this very valuable opportunity to present on a non-gynec completely non-academic subject, but yet one that is very, very important. So we are going to talk about stock selection using the Wealthcon MPTDS criteria. I'll try to be brief as well as comprehensive so that people who are not part of Wealthcon and have not heard this before will understand and will actually be able to apply it in their day-to-day life. So first of all, we will start with what is MPTDS. MPTDS is an acronym, a short form, and on the face of it, you can call it a simple method to screen and differentiate between reliable companies that can be safely invested in versus risky companies that we should stay away from. So when any talk about stocks or shares is delivered to the average doctor or gynecologist, the first question is how much time will it take? So literally this will take not more than hardly 1 or 2 minutes per stock. So that's only the amount of time that you have to spend to be able to do this. And the second question always is how much effort is this going to take, because I have zero prior knowledge about stocks, shares or anything of that sort. So literally anyone with zero experience can use these criteria. They have been designed in such a way by Dr. Ram sir that only common sense is needed to be able to apply these criteria and to find out whether or not a particular stock is good or not. So what are the components of this MPTDS? Like I said, MPTDS is an acronym, a short form. So M stands for market capitalization, and in very, very simple terms, market capitalization means what is the total value of the company as of today. It can be calculated as the share price of the company today multiplied by the number of shares which are available in the market. So for example, an even easier way to look at it would be if you had to pay money and buy off the entire company today, how much money would you need? So for example, in order to buy Reliance, you would require only 19.21 lakh crore rupees to be able to become owner of Reliance. So it is very much doable. Then we start off with M. So M is market capitalization. Yes sir. बोलने में क्या जाता है? So we start off with the M of market capitalization. And the M, the market cap, what we require is a market cap of more than 10,000 crores. Why not companies less than this? Because it removes all the smaller companies, and with larger companies comes more stability and more promise that this company will not default till the time that your money is invested in it. Like Ram sir says, sometimes the chance of an MPTDS company defaulting is less than you checking out of the planet before the company actually defaults. So MPTDS more than 10,000. Then we come to the second one, which is the P, the price of the share. And what parameter are we looking at when we look at the price of the share over the past 5 years or 10 years? It's very simple. It should be steadily increasing, not rapidly increasing, but steadily increasing. And the reason for that is the increasing share price is an indicator that the business of that company is doing well and it will growing over time. So it is safe to keep your money in that particular company. Then we come to the third component, which is the T. The T is the tax paid. And again, we are looking at the same parameter. The tax paid by the company must keep on increasing slowly and steadily over the past 5 years or 10 years. And why is this important? If the company is paying more tax to the government, it obviously means that they are making more profits. The business is ethical, that is why they are paying more and more tax to the government. And if what Dr. Ram always says in his lectures is that out of the MPTDS, maybe there can be cooked books of accounts and some extra profits shown here and there, but no company will additionally pay extra tax to the government just to cook up their own books and show that the company is doing well. So among all the criteria, tax paid seems to be the most reliable criteria to see whether the company is actually doing well or not. Then we come to the D. D is dividend. For those of you who may not be aware, dividend means a distribution of the company's profit to its shareholders as a reward for their investment. So it's like giving them a bonus. And what we require, the criteria again is very simple. The dividend should be increasing over the past 5 years or 10 years. Again, why the reason for this? Because increasing dividend paid means that the company is having a good management and is willing to share part of its profits with those shareholders who have believed in that company and are ready to invest in it. So again, dividend should be increasing over the past 5 years or so. And the last component is sales. So the sales of the company, again the same criteria, increasing over the past 5 or 10 years. So they are very simple, all criteria increasing over the past 5 or 10 years, that's it. And why are sales important? Because we are already looking at the market cap, etc. But if the profits of the company are increasing and the sales of the company are also increasing, it means that the company is actually making money from its businesses, not from some illegal sources like funding from outside or some XYZ party. It is actually doing good business, increasing its sales, and therefore making more money. So these are the 5 components of the MPTDS. Now all that is okay, but I want to actually see it, and I said you can see it in 2 minutes. So actually, how can one see it on their phone or on their laptop? The website is simple. It is called www.screener.in. This is like as the name suggests, it's a screening website. So you can screen the stocks on this website. You can go through the trouble of going to the individual company's balance sheets also, but that will take a lot of time. This is considerably, means highly reliable data, and it can be seen. You can also get the same details from individual company website. So now let us actually see how to screen these stocks using MPTDS. This is a screen recording, but all of you, those who have internet access, can do it immediately after this also. Okay, so this is, let us suppose you are online. You go to the website www.screener.in. This is the website that you have to visit over here. Once you go to screener.in, this is the page which opens. You need to log in. So one time effort is of creating your own email ID and password, and then you can log in. So once you log into Screener, it will save your credentials, and next time you will not have to log in again and again unless you log out. Once you are there inside, you will see this kind of interface, and on the top you see screens. Screens means basically you are creating filters. So what exactly do I want to see in companies? You are writing that on the chart. And you say create new screen. So when you say create new screen, this kind of a window will open up, and where it will ask you to put a query. In that query, you start typing market capitalization, and you see the first thing that comes up is it will auto fill the whole entry, and you will get market cap. And if you say more than 1, so all numbers are in crores, and if you say market cap more than 1, and for example if you run this query, then what it will give you is it will give you all the companies that have got market cap of more than 1 crore, but you see that there are more than 5,000 such companies, so it's impossible for us to screen so many companies. So instead of that, we will go with the MPTDS criteria. So you go to screens again, create new screen, and this time in the market capitalization you write not more than 1, but you write more than 10,000, and you say run this query. When you say run, you see there are directly 1/10 of the companies have been selected, everything else has been eliminated, so that makes the work for us 10 times less. Then you can take any company. I have chosen Nestle India because it is something that all of us know, we eat the chocolates, etc., etc., milk of Nestle. Sorry, yeah, Maggie, of course we eat Maggie, and we start right from the top line of the interface. You can see the market cap is seen 2,49,000 crores. So the M criteria is definitely satisfied. So now let us go down. As you scroll down, this you can see on your phone only. As you scroll down, you will see the price over here. You can remove the volume. We are not going to discuss that. But if you look at the price, and here you can select you want the price over past how much time. So you can select 5 years, 10 years or max. When you select 5 years, you can see visually at least, ignore the slight ups and downs, but you can see visually at least that the graph is an uptrending graph, which means that compared to what we started with over here 5 years ago, the company's share price is better. When you go to 10 years, you can see the performance over the past 10 years. So all the dips, they smoothen out, and you can see a straight line going up, and max means it is right from inception of the company. So you can see all three. Then as you scroll down, ignore the whatever is written as of now, but there is a column as we go down which says cash flows, and this is the column that we are looking at to go to the next one. So the M is done, the P is done, now we are going to the T, which is the tax. And here there are 3 columns: cash from operating activity, investing activity and financing activity. So ignore what they mean for now. We are interested first in cash from operating activity. And as you go down, you see here it is direct taxes. just by looking at these numbers. Ignore the minus sign, because the minus sign means tax paid out to the government, going out from the company's coffers. So minus sign means tax paid. As you see these numbers, you can see these numbers are steadily on the rise, which means that the tax paid by the company year on year is keeping on increasing. Maybe there might be 1 or 2 dips in the middle, but essentially you can see just by eyeballing that the tax paid by the company keeps on increasing. Now one can minimize this, and there are 2 more. So we go to cash from financing activity. Again, as you go down here in cash from financing activity, you see dividends paid. And again, if you do an eyeballing of the numbers, you will see that the dividends paid by the company have been gradually increasing year on year. So M, P, T and D all are valid because they have a steady uptrend over the past 5 years or 10 years. Then we come to the sales or the S component. So the S component is the first one, but since we prefer to go by the mnemonic, we go in that way. So scroll up, and up you will get the S component. In the sales component, so here you will see there are some quarterly results, and there also you will see sales, but ignore this, because if you look at these numbers, you will find that these numbers are more or less static, but these are quarterly results. We are looking at year on year performance, not quarter on quarter performance. So ignore the quarterly results, scroll down, and you will get profit and loss. These are the yearly results, and there you will see sales. So again, in sales, if you see, you can see year on year, maybe some dips here and there, but the numbers have steadily been increasing, which denotes that S component is also valid. So M, P, T, D and S all are valid, and this is an MPTDS valid company. Let us take another company for example. For example, let us look at Yes Bank. We all know the Yes Bank fiasco, and if you look at the market cap, 66,000, so the M component is valid. But as you go to the price component, when you go to 5 years, you see that this is not looking to be very good. Over 10 years, if you see, the price has sharply dropped, and if you see, it started dropping somewhere in 18-19. This is even before COVID. So this has nothing to do with COVID at all. This is just something to do with the company. Then you ask some senior, or you yourself can investigate what exactly went wrong. But on the face of it, you know that this is something dangerous and I should probably stay away from it. Analysis is over. There is no need to go deeper because one criteria has not been satisfied, and this is what the max looks like. Let us take another company just for the sake of explanation. For now, we can look for maybe Reliance Communications. This the Anil Ambani owned Reliance Communications, and if you see the market cap, 279 crores. So analysis is over. There is no question. Less than 10,000, you can look at the price, etc. But there is no point. In the first criteria itself, the company has been eliminated. So with in Wealthcon, we keep having these G10 kind of meetings, and someone suggested to look at Swan Corp Limited. None of us had heard of it. So we said, let's take a look at the MPTDS of Swan Corp. 12,000 crores is the market cap of the company. Let's look at the price. So the price seems to be more or less same. In 5 years, okay, but in 10 years, see what has happened. Price from somewhere 2016 to 23, the company did nothing, and suddenly the profits of the company have increased. So this kind of raises a red flag. So you can investigate what exactly happened that the company's profits shot up so much. So if price is okay, let's look further down at the rest of the parameters. And if we go to profit and loss, and if we go to cash flows and cash from operating activity, let's look at the direct taxes. A 12,000 crore company is paying only 2 crores, 0 crores in taxes. 2 minus 7. So there is definitely something which is a problem. I don't know. I'm not an expert in the subject, so I don't know exactly what is happening. But even the dividends paid have been static year on year. So at least I can investigate further and see exactly what the problem is. Again, if you look at sales of this company, if you look at these figures, 300, profit and loss. So 300 up till here. And if you see between March 2022 and 2023, in 1 year the profits of the company tripled, and in that next year 23 to 24 they became 5 times. So what exactly happened with this company that it became so profitable? It is time to investigate. So that's basically how MPTDS is going to help us. So this is the overall chart of MPTDS, and this is what you actually have to see along with the flow chart of how you go one by one. It's quite easy to do. First 1 or 2 cases might be, first 1 or 2 instances might be difficult, sorry, and then subsequently you will have to. Also, if you are still not convinced, you can plot the values in an Excel chart and see it. The chart is obviously seen to be in an uptrend in terms of tax, dividend and sales. So finally, to conclude, there are some constraints and there are some strengths. Everything, a tool cannot be universally applicable and have 0 flaws in it. So all companies that are eliminated by MPTDS criteria may not necessarily be bad. There may be smaller companies that have got good potential. They are yet to become giants. They are still children in school, in college. Who knows who will become next CEO of Microsoft? We don't know. But these companies are covered by a different criteria, which also Ram sir has designed in Wealthcon, called MD Sport criteria. We are not discussing that now, but the main strength of this, rather than looking at it as a one-stop solution to all problems, the main strength of this is one can quickly get a preliminary assessment of the company rather than acting impulsively on tips and putting your money in a risky spot. So I thank all of you for the opportunity, all the participants, Dr. Nitin Shah, Honorable President of AFG, and of course Dr. Ramnath Ghute sir, founder of Wealthcon. We really salute you, sir, for your exemplary service to the medical fraternity. Thank you very much.
I think I must thank Dr. Pesat. The first session was really beautifully explained. I think as beautiful as you do your laparoscopic surgery. So congratulations. Thank you for awakening us with this session. And now we go to the second session. We have Dr. Kedar Marathe, and he is going to be speaking on criteria for selection of mutual funds. Welcome, Dr. Marathe. And yeah. Thank you.
My pleasure.
So Dr. Kedar is an obstetrician, laparoscopic surgeon, and a consultant from Pune. Welcome, Dr. Marathe.
Today you will see a different angle of gynecologist.
At the outset, I would like to thank Dr. Nitin and organizers for calling me for this opportunity and deliver this smaller topic. Thank you, ma'am. So, Dr. Sanket had like beautifully talked about the selection of different kind of companies for passive investors. Now today we are not talking about trading, we are talking about investing. So when we delve into the, like as a beginner in the investments, especially the equity investments, we have different choices. One of the investments is like direct shares, into investment into direct shares. The other modality which most of the people to begin with go as mutual fund investment. And today we are going to talk about mutual funds and how to select mutual funds, how many mutual funds and which kind of mutual funds, and that's what I'm going to talk about. First of all, thanks to Dr. Ram, who's founder of Wealthcon, which is an association by the doctors, of the doctors and for the doctors. He has developed a lot of criteria like MPTDS criteria, MD Sport criteria, CARESA criteria, which is like for selection of shares and mutual funds with different objectives in mind. So most of us know about mutual funds, but we will just delve into what exactly these mutual funds mean. Now, as a passive investor or as a beginner, many times we are a little scared of buying shares directly. So most of the times we go for something called as a mutual fund. Many times, many agents do meet us, even the bank, say representatives come and talk to us about that, okay, these mutual funds are good for your investment and XYZ things. So we know that, okay, mutual fund is like an equity investment, but exactly what they are. Now, as a passive investor, there are 2-3 things. One thing is selecting the, of course, MD Sports or MPTDS criteria are very simple for us, but to begin with, we might be little hesitant to go for a direct shares investment. So what we do is we put in some money, give it to somebody who is an expert in this field, maybe working for a selection of these companies proper, buying time, proper selling time, and creating a kind of a profit which we feel that we should be eyeing on. And we rely on the expertise of that person. We give that person some money, and that person is going to collect the pool of money from different retailers or retail investors like us, and going to invest that money in different companies. Now, when he invests, obviously we give him a right to buy certain stocks and sell certain stocks. It can be stocks, it can be other securities also. So as we are going to see, that mutual fund can be an equity mutual fund where the investments is going to happen in different shares or stocks. It can be gold mutual fund where the investment can happen in gold. It can be different debt products like different corporate bonds or government bonds or different kinds of short-term investments. So he can invest in those securities and then create a kind of a profit which he is going to pass on to the investor. Obviously, he is going to charge some fees for that because of his services. And that is how the mutual funds are going to work. Now, basically, we have to understand what are the advantages. Now, when we look for a direct investment in any debt product or equity or anything, and compared to that mutual fund, what are the basic advantages? So, the advantage is diversification. So, suppose if I want to invest in first 50 companies, like Dr. Sanket talked about market capitalization, right? So larger the company, it's going to give, the largest company is going to top the list. And likewise, we are going to have, suppose, first 50 companies. If I want to invest in first 50 companies, maybe one share can cost me, say, 2,000 to 3,000 rupees. So if I want to buy even one single share of 50 companies, probably my basic investment size would be something like 30, 40,000 maybe. But suppose I'm a very small investor, I would like to just invest 5,000 rupees per month, then it is impossible for me to buy even single share of first 50 companies, right? So then if I suppose invest this 5,000 in some mutual fund which is going to invest money in these 50 companies, what happens is many such individuals who are going to invest like me, and the big money is going to create it. Suppose we consider 10 people and basic investment as say 50,000. 10 people's money is going to get collected as 50,000 rupees, and that is going to get invested in first 50 companies. So what I do is, even with smaller amount of investment, I get a diversified investment, because we always say that diversification is going to make the risk lesser. More the companies we are invested in, probably the risk factor, because if you are invested in one particular company and that company suppose doesn't perform well, all our investments are at stake. So diversification is the first advantage. Second advantage, as I just talked about, is even a smaller ticket size. So we can start investing in mutual funds with as minimum money as 500 rupees. Okay, so that's a very, very little amount for us, but then, even an investor who can invest 500 rupees per month can still go and invest his money in mutual funds. So that is second advantage. Third advantage is, of course, the expert fund manager, because there is somebody who's called as a fund manager, whose expertise we rely on, and he is going to select the companies with his understanding analysis, and it's his full-time job. So he not only understands that which shares to buy at what point of time, but he also understands which shares to sell at what point of time, because profits are going to be made only when you complete both things, right? When you buy and then you sell, and only then you're going to create a profit. So he can do that maybe far better than us, maybe, as I'm saying, because if you become expert, of course you can even beat his performance. But these are the basic advantages of mutual funds. Now we'll just roughly categorize mutual funds into basic categories. Like one can be equity funds, where we invest in shares in stock market. Others can be debt funds. So debt funds is like where we invest money in different debt products. Debt products are something like as simple as FD, fixed deposit. Fixed deposit, we can call it as a debt product, where we put in some money, we get some kind of a fixed returns. Obviously those returns are not exuberantly high. We get say around 6% returns or something like that. So there are different kinds of bonds, different kinds of debt products which we get. And then there can be hybrid funds, where part of the fund can be invested in equity, part of the fund can be invested in debt product. They are like balanced funds, hybrid funds, different kinds of. Now, as such, there will be many classification of mutual fund, but for somebody to just remember what exactly the overview should be, then these will be the kind of funds. Now, when we see equity funds, then we can broadly divide them into three basic categories. Of course, there will be many categories, I know, but broadly, if we are considered, we can divide them into three categories. Now, Dr. Sanket talked about something called as market capitalization. So market capitalization is what we are talking about, the size of the company. If you want to buy out the company as a whole, 100% shares, then how much money we would like to put in. Now, depending upon this market capitalization, SEBI has kind of divided companies into 3 different categories: large cap, mid cap and small cap. SEBI recognizes around first 500 companies in this. Companies beyond first 500 companies we are not going to consider. 1, because there are much smaller companies. 2, Dr. Sanket talked about companies more than 10,000 crore capitalization, right? And the number, if you remember, was something around 540 or something like that. So obviously that means we are going to consider first 500 companies as the companies where we would like our money to get invested in. These are probably good companies because of their market capitalization. Now first 100 companies will be categorized into large cap. Next 150 companies will be categorized into mid caps, and the next 250 companies will be categorized into small caps. So whenever we look for any mutual fund, generally the mutual fund talks about whether it is a large cap mutual fund, mid cap mutual fund or small cap mutual fund. These can be the primary categories. Obviously there will be flexi cap, there will be different kinds of where we give the fund manager kind of a opportunity to switch his fund percentages into different kind of categories. So he can invest some money in large cap if he feels that no, currently large cap funds are not, companies are not doing that well, but probably mid cap companies are going to do well. He can push more money in mid cap and so on and so forth. So broadly to remember, these are the categories, but obviously there are much more categories in mutual funds as well. But this is to make it much more simplified. Okay, now when we actually are going to buy mutual funds, most of the times, most of us are exposed to somebody who is giving us a call or giving us an advice and tell us that, okay, if you're keeping your large amount of funds in your fixed deposits or something like that, probably it's better to invest in some kind of a mutual fund which will give you better returns. If FD is giving you 6% return, some fund can give you 12% return, 13% return, 14% and so on and so forth. Most of the times we are going to invest in that, looking into this advice, but most of the time these mutual funds are regular mutual funds. Now the word regular mutual fund sounds very benign, right? But the word regular mutual fund means that there is some commission involved of somebody who is giving you the advice. All right. So there are 2 kinds of funds: regular mutual funds and direct funds. So suppose there is a fund manager. Obviously there is a asset management company. It can be anything. It can be Kotak, it can be ICICI, it can be Axis, it can be anything. These are all asset management company. These companies will have one fund manager for that particular fund, and he's going to collect money. Obviously that fund manager is going to charge us something as his fees of expertise, and that what we are going to call it as expense ratio. So expense ratio means the fees he's going to charge. That is fair because he is charging for his expert advice, whatever he is going to do with that money. But on top of that, there will be some more expense ratio which will be added because that somebody is advising you to buy some particular fund. Now he is not adding any value to the performance of that mutual fund, right? So he is just charging some kind of a brokerage, right, for just giving you advice that which fund is to be bought. Now that brokerage can be 0.8%, 1%. Now you may feel that 1% is very small amount, right? If my fund is performing 14%, 1% is very little. But when we look at the total expense ratio, we understand that if one particular fund, suppose if I buy a regular mutual fund of same company and Dr. Sanket buys same companies, same fund, same manager, everything same, but direct fund, my expense ratio is going to be say 1.8%, his expense ratio might be 0.8%. So I'm paying 1% extra for technically nothing. Okay, and that 0.8% is the charges of that fund manager who's putting all his expertise, but 1% is just like the advice fees that broker is going to ask for. Now, if you look at the long-term result, we can understand that the green graph is the performance of the direct mutual fund and the blue graph is the performance of the regular mutual fund. And you can understand that over a period of time, we are going to pay a hefty price just for that advice that which mutual fund is to be bought. And I think that's something which is a very, very simple thing. Just as Dr. Sanket told about 1 or 2 minutes for the selection of MPTDS, one company, selection of mutual funds will take us, screening all the mutual funds in one category will take us not more than 4 to 5 minutes. So we are going to look into that as well. So to save a lot of money, which we are going to pay for nothing, we can actually should always go and select a direct mutual fund. So that is something important. Now, then there are, fancy things, fashions in the market that, okay, NFO, it's like a new fund somebody is going to launch, some company, and obviously that company is going to market that fund. They're going to advertise that fund. The agents are going to come, they're going to come to our doorstep and talk about this company is, starting a new fund and it's going to be this, that, all stories. But now we have to understand that we can't believe stories. We have to believe the facts. So unless one fund is being there in the market for at least 5 years and we have seen the performance of that fund for 5 years, we shouldn't be going for that fund. We should always go for a fund which has shown us the result. If the data is being seen, I think that is something which we need to believe. So NFOs or new fund offers are definitely to be avoided. Similarly, there are sectoral funds. Now sectoral funds are not bad, but for a beginner, we have to be very, very vigilant, because what happens is there are different sectors like auto sector, oil, energy sector, IT sector, and now we can see that these sectors may have their cycles. So for some years, maybe 4 or 5, even sometimes 10 years, one particular sector may just have, goes down in terms of the share prices and doesn't show any performance. Now what happens if we put a large chunk of money in some sector which is going to go down or not going to show us any results in next 4, 5, 6, 7 years? Probably it's going to be very, very difficult for us to keep that money where we are seeing that it is not growing even with the FD rate, not even 6% returns or something like that. But if we go for investment which is across the sectors, like suppose first 50 companies. Now when we say first 50 companies, obviously it will take into consideration most of the sectors, because every leader in that sector will be a part of those 50 companies. So most of our investment will get diversified. Now this word diversification is very, very important to mitigate the risk. So generally, to begin with, we shouldn't be going in any sectoral investment. Similarly, we shouldn't be going in any solution oriented funds, because they don't just mean nothing. Most of the times people who are going to sell us funds are going to be, this is for child education, this is for retirement, this is for X, Y, Z. Now these names don't mean anything. Now if it's a child education fund, means what does it do? Eventually it's going to put that money in some company. Now child education is to just lure us or kind of emotionally blackmail us to make, oh, we should be doing something for our child, so it's our duty, so we'll put in money in that fund. But doesn't mean anything. The name of the fund, whether it is a large cap fund or a small cap fund or a mid cap fund or a child education fund, doesn't mean anything, because essentially the money is going to get invested in some shares. And that is very important, at which shares the money is going to get invested, what are the track record of that fund, who's the fund manager, XYZ. So we should be avoiding all such kind of fancy names and all such things. Then there are different kinds of funds called as growth funds and dividend funds. Something very simple. Now imagine FD, fixed deposit, where we are putting say 1,000 rupees and it comes as a 6% returns. And what generally we do is, suppose we keep it for say 5 years. What happens? The 60 rupees which we are going to get are going to technically get reinvested, and that 60 rupees is again going to give us returns year on year, and so this is called as compounding effect. So compounding means what? If you are getting some profit, it is getting reinvested in the same product, whatever you are buying, and that reinvested value also is creating a profit. So technically the amount of profit which is generated is going to be far better than otherwise. Now in dividend kind of fund, or there can be dividend reinvestment funds, what happens is they pay you some dividend. Now here we are investing because we obviously have a surplus money. Here our aim is not to get any returns out of it in terms of yearly returns. So we are not interested in dividend. Secondly, the dividend is going to kill the basic principle of compounding effect. So we should never go for a dividend fund whenever we are going to go for any long-term investments. So always should be growth funds. So there are basic two things, that any investment should be in direct mutual fund, never in regular fund, and any investment should be always in a growth fund, never any dividend fund or dividend reinvestment fund. It is absolutely irrational to do that. And the third thing, as we are going to talk about, as we talked about, that which kind of fund are we going to select? Large cap, mid cap, small cap, flexi cap, XYZ. So these are certain don'ts in mutual fund investment. As we say, no NFOs, new fund offers, never invest in sectoral funds, at least as a beginner. No solution-oriented funds, no dividend or dividend reinvestment funds. Never invest in regular funds, obviously. And don't keep churning your mutual funds. Like, don't keep on buying and selling, because what happens many a times, the mutual funds also have something called as an exit load. So if you buy and sell the mutual fund within 1 year, there can be exit load of 0.8%, 1%. So obviously you're going to lose money on that. So these are the don'ts, because don'ts are very, very important before we understand what are the do's. Now, the do's when we come to, so, you know, it's like, can we become expert in finding the mutual funds? Absolutely. It is very, very simple, and we're going to see how are we going to do that. Now, if we look at the mutual funds, what we have to understand, any mutual fund will have some, baseline index or something which, when we talk about large cap funds, that means the first 100 companies. If we say that if we blindly invest in first 100 companies, what will be the performance? That is Nifty 100. What will be the performance? And our mutual fund, how much the performance is compared to that. So if we compare, then all the mutual funds do not beat even index. That means even if we blindly put in our money in the index or index investment, the mutual fund, since it's an expert managed fund, it should give us a better returns, right? But we will be surprised to see that hardly 10 to 15 mutual funds are able to beat the index, and that is something which is very important. So selection of mutual fund is very, very important. Now, Dr. Ram has developed some simple criteria. They are called as Karesa criteria, and we'll see what they are. So this is basically to select good mutual funds, and these are the criteria. So it's a category of fund. Obviously, we saw what kind of fund we want to choose. Age of fund, we saw that no new funds, at least 5 years experience. Asset under management, just like market capitalization we talked about for an individual company, we also want to see that how many people have invested how much money. If some fund is being, having say 10 crores, 100 crores, we call that as asset under management. I think very few people are invested in that, right? If at least more than 500 crores is being the total amount collected, that means many people are showing faith on that fund and that fund manager. So probably the fund being good is, the chances are greater. Obviously, this is not the only criteria. There are other criteria as well. We also have to see the returns. So how much returns the fund has generated over last 10 years, 5 years, 3 years, 1 year, and that is also to be compared with the returns which the index is giving us. Expense ratio, as we say, if the expense ratio is something like 2%, 2.5%, I think that is too much. The fund manager is going to take away from us. So that is something which is, because expense ratio is going to erode our profits, right? But we are okay to give some money if the fund manager is generating higher profits. If the fund manager is generating 4 or 5% on top of the index, we are ready to give 1% to that fund manager for his expertise, right? And then there is something called as a Sortino ratio, something called as a alpha. So let's not get overwhelmed with these concepts of Sortino ratio and alpha. Sortino ratio generally means that if the market goes down, obviously market does go down, right? The market doesn't just go straight high in just one single linear line. It goes up and down, and then whatever the downside risk the market does have, whether this fund is having a lesser risk than the index. And alpha is whether this fund is able to generate higher profits than the market. So that is what we are going to look at. Now we can divide these criteria into these 3 elements. First is category of fund, obviously which kind of fund we want to select, whether we want to select large cap, mid cap, small cap, flexi cap, XYZ. So that is first thing. So that we have to select. Second thing is the elimination criteria. So what are the elimination criteria? Elimination criteria is age of fund. As we say, it should be more than 5. So all funds less than 5 years we are going to eliminate. I would like to welcome Dr. Ram. Yeah, So that is the first elimination criteria. Second elimination criteria is asset under management. So obviously anything less than 500 crores we will like to eliminate. Expense ratio is if suppose more than 1%. I think that is probably too much of price we are paying or too much fees we are paying. Sortino ratio, as I said, the downside risk. If it is more than 1, that means probably the fund manager is taking care of the downside risk also. And if the alpha is more than 1, that means he is generating higher profits than the index. So these are the elimination criteria. So Sortino ratio less than 1, alpha less than 1, we would like to eliminate. And the last we are going to look for the returns, because we have to look for the safety first, we have to look for the performance in other terms first, and then we are going to look for the returns. So once we screen the funds, into these elimination, through the elimination criteria, then we are going to select in terms of which funds are going to create larger returns. Now, just little bit about, as we say, age of fund. So we are going to believe on data and not the story. So if the fund is there in the market at least for 5 years, we are going to see that what is the performance of that fund, and only depending upon that we'll be able to select the fund. Any new funds or any fund which is just in the market for a year or two, we are not going to believe that. So that is something which is important. Second thing is asset under management. As we are going to see, more number of investors and the amount of money they are putting in that fund, they are going to put a lot of faith in that fund and that fund manager. Obviously this comes with performance. So better the performance, I think as we go ahead, the asset under management is going to grow. So higher it is better. As we say, the elimination criteria is minimum 500 crores. Expense ratio, as we say, minimum the expense ratio, better it is. So up to 1%, we are okay to pay that much price. Anything which is more than 1%, I think it is too much price to pay. So that is something which is very important, because it is going to erode the profits. All right, now we are going to just look into the two little difficult things, but not that difficult to understand: Sortino ratio and alpha. So what are they? Now this is a kind of a graph. Any share you say, or any index you say maybe Nifty 500, Nifty 50, Nifty 100, anything, any index if you see, generally this kind of a graph we are going to see. So where there are ups and downs, sometimes the prices move up rapidly, sometimes they correct, again they move up, and something like that. Now the midline is something which is like the overall graph, and we say that the overall market is going up. But of course there will be highs and there will be lows. Now what are we aiming at? Ideally, what should I be aiming at? That when the market is behaving like this, when the market is especially going down, my fund or my portfolio should go lesser than this market. So the market is correcting by 20%, my portfolio would correct by say 15%. That is my aim. And if market is rallying by 10%, my portfolio should run 15%. So that is most ideal thing. Obviously every time it is not possible, but that should be what your aim is. So this is my aim, to push my profits beyond the the profits generated by the market. And this is what my aim is, that my performance of the portfolio should be better than the downside. This is very oversimplified thing, but just for understanding. Now that means we want to create higher alpha, that means we want to create higher profit than the index, and we want to create higher Sortino ratio. That means we want to have a better downside risk management. Okay, so we want a graph something like that. Okay, so the red one, which our fund should perform compared to the index. Okay, and this is generating higher alpha and higher Sortino ratio. So that's why we want to select a kind of a fund which is creating both. Now Sortino ratio, this is some jargon which you can absolutely forget about how to calculate Sortino ratio and all, but not important for us. We are not going to calculate it. We are just going to look at the actual value of Sortino ratio. Alpha is as simple as the baseline index, what we are, if we are investing in, compared to that if the fund is generating higher returns. Again, this is not to be calculated. This is generally given in the data which is available. So the prescription of mutual funds. So how many mutual funds one should buy, and what number in each category? So as we say, there are different categories of mutual fund. Obviously the lower ones are liquid fund, arbitrage funds, which are the debt funds. So we are today right now discussing only about equity, but I just put those in the list. ELSS funds are the tax saving funds, because previously under ATC the ELSS funds were tax exempted. Now with the new tax regime, that probably benefit is going to go away. So now probably ELSS funds may not make that sense of investments, but generally we can look for large cap funds, mid cap funds, small cap funds, and flexi cap funds. Maybe two in each category we can go for, and maximum around 10 to 12 funds we can select. Too much of diversification, like selecting 25, 30 mutual funds, doesn't make any sense, because whatever returns we are expecting and whatever risk management we are expecting, I think can be very well managed in that. Now we can select obviously direct funds. We should select obviously growth funds, maybe around 10 funds. And what should be doing is doing SIP. SIP is what? It's an automized investment. Every month some amount of money, whatever that person is able to, 5,000, 10,000, 20,000, 1 lakh, 2 lakhs, whatever amount he feels that he should be investing every monthly in all these funds, he can create an SIP. It's very easy now on our mobile. There are different apps, different portals which are giving this facility, and it is automized. We don't have to do it every monthly. It can be just made it once and it keeps happening. And then there is something which is called as a dip buying. So what is dip buying? We know that the markets do correct. So many a times markets correct 15%, 20%. Now these are the opportunities where we should pitch in. It is like the Levi's jeans is generally been sold at 5,000 rupees, and now there is a sale. Now it's been sold at 3,000 rupees. Does the value of that Levi's jeans goes down? Not really. The price has gone down, not the value. So what do? Whenever there is a sale, we jump in. Monsoon sale, Christmas sale, X, Y, Z. So what we do is we actually jump in and buy more. So the same way, if the market is corrected, probably it is giving us opportunity to enter and buy more. So that is called as dip buying. So we can invest in the same fund in such scenarios, put more value. Now, yearly assessment is also required. Obviously, we can't keep looking at the fund every day or every month.
Dr.
Or
Kedar,
yeah, sure.
we are
We are exceeding? Okay, I think I'm just on the last slide. So we shouldn't be doing that frequently. So yearly assessment is what is something which is necessary. Again, the criteria is the same, but mostly we have to look for certain red flags. So if the fund is not performing for 1 year, what we can do is we can stop new investment, keep the older investment in place. If the fund is not performing for 2 years, probably we can think of redeeming. So these are different platforms which we can use for fund investment. I'm not going to show you today for lack of time how to select, but these are some take-home messages which we already talked about. And as we say, to begin this journey of passive investment, I think mutual funds is one of the very good tools, and we can start that simply by selecting these mutual funds with CARESA criteria, and they will help us in our journey of passive investment, definitely. So thank you very much.
Thank you, Dr. Kedar, and very well elaborated an understanding of mutual funds, the do's and don'ts, and the elimination. So thank you so much. We will now invite our President, Dr. Nitin Shah.
Sir needs no introduction. Sir is currently the President of AFG, renowned endoscopic surgeon. Sir, we welcome you.
So good morning everyone. Today my topic is on taxation for the medical doctors. So thank you Ram sir, Wealthcon and AFG for giving me this platform and able to speak on something like a topic of finance and taxation, which we always fear about. So how the doctor life plan goes, be a doctor, marry a doctor, bully your kid to become a doctor, find a doctor spouse for them, and this vicious cycles continues. Doctor is a noble profession, busy and hardworking. We are a gynecologist, so we are really hardworking gynecologist. Doctor is good at earning, spending and saving, but when it comes to investing, I think they have a very poor knowledge because somebody else will take care. And when it actually comes to tax knowledge, it's a big problem. Taxation, we hope that our CA will manage our taxation. With all his guidance, we have a blind faith in our CA and we follow. वो चिट्ठा भेज देगा quarterly इतना भरो and we pay the tax and we get rid of it. So don't hope is not a good success strategy. No one will come to your rescue. Stop excuses, stop blaming, stop criticizing. Exercise your brain and get smarter. हमको तो टैक्स के नाम से ही डर लगता है, This is our situation when the tax planning actually starts. But Ram sir always says,
डर का किस बात का डर है तुम? किस बात का डर है?
And he started the journey of Wealthcon, taking more than 10,000 doctors with him. Thank you, sir, for being there for us. And he always says, किस बात का डर है तुम्हें? मैं हूं ना. So why to learn taxation? Tax management is to reduce the tax liability in terms of tax, and what is ignored is surcharges, interest and penalty. We always ignore these three columns when our tax challan comes to us, we ignore and we pay it blindly, So that is important to aware that below tax there is something called as the interest, penalty and surcharge. Tax, and our focus should be increase post-tax income. That is very, very important. So take-home message is understanding tax and inflation is very important because our return should beat tax and inflation both. Okay, no one becomes wealthy by buying policies, plans and scheme. And as we know, the inflation is a invisible enemy because what sugar we buy at 10 rupees in 2010, now it's costing more than 50, 60 rupees. Even Nifty, it was 5,000, now it is more than 26,000. So how this inflation hampers our return. Suppose if you do a bank FD at a rate of 7% interest and if you come into 30% tax slab rate, which I think all the doctors are, so our returns is post-tax, it is just 4.9%, and if you suppose the inflation is 6%, at the end of the year, your returns is actually negative, meaning that if you have invested 100 rupees in FD, at the end of the year, you are getting 98.9. That means actually your rupee is getting depreciated, your investment is becoming lesser and lesser year on year. So our return should be both this tax and inflation. That is very, very important. The death and taxes are certain, as per said by the Benjamin Franklin. If you have an income, if you invest in asset, you will have an income tax. If you spend, you will spend in terms of GST. Our principle is to reduce the tax legally, increase post-tax income and invest maximum. So these are the activities. If you earn, you pay income tax to central government, professional tax to state government and local taxes to municipal corporation. If you go on spending, you pay central GST, state GST, entertainment tax, excise duty, custom duty, water tax. If you invest, you incur capital gain tax, security transaction tax, stamp duty, road tax, property tax. So you label and tax is behind you. Mind you, you cannot accept the tax, so you have to, whether you earn or you spend, you have to pay tax. Suppose if you purchase a 30 lakhs car, this is a total summary estimated. If you buy a petrol SUV for 30 lakhs on-road price in Maharashtra, what GST you pay, You pay approx 8.5 lakhs GST on that car. Road tax is approx 4 lakhs and TCS is 30,000. So tax burden is approx 13 lakhs, that is 42% of the car value is just a tax. आज हमने 30 लाख का गाड़ी, उसका वैल्यू तो खाली 18 लाख है. 12 lakhs you are spending in tax. A quick tip is buy EV vehicle worth rupees 30 lakhs. GST drops to 5% and there are no road tax, no government taxes, and you could easily save 10 to 12 lakhs, So taxation simplified by Ramsey's classification based on person, whether you are individual or a proprietorship, whether you are running an Hindu undivided family HUF or you have a firm which includes partnership or LLP. If you are a company, private limited or public limited or a trust. So this is broad classification in terms of person. We'll come across a lot of mnemonics and acronyms because as MBBS student, we always remember things in acronyms, So Ram sir has given many acronyms to remember how to remember and simplify the topic so that the doctor can grasp it easily. So this is personal classification, and then depending on the income source, you will be classified into salary income, you will classify as a business income, house rent, interest, dividend, and capital gain. So your income is broadly classified in this. Okay, in lower side you will remember as a Salman, Bide family and captain. This time I think Ram sir has introduced in IMP. It was a fantastic way to remember your income category. Okay. Salary, which is Salman Khan. So salary income, many of you are employed in BMC or somewhere or in corporate and you get a salary. So income will be classified in salary. Other will be BIDE. BIDE is an acronym for the business, house rent, interest, dividend and others. And captain is capital gain tax. So this makes us very simple. Broadly you classify your income in this category and it becomes very, very easy. The third is depending on your slab rate, tax rate. So generally, first two category of the income, salary or a business income, sir rightly said Sala Bide to remember, salary plus Bide. Bide is business, house rent, income, dividend and others will come under the slab rate. There are various slab rate, 5%, 0, 5, 10, 15, 20, 25. We'll see in subsequent slide what this slab rate tells us. And there is a special category where is a flat rate. Okay, so capital gain. Suppose you have a shares, you sell within 1 year or 2 years, you have a particular tax rate. It will be not charged at the slab rate, but at a particular flat rate. Even crypto, gambling, or if you have a firm, suppose you have a firm with your wife, I made firm with my wife, my income will be flat tax at 30%. And companies and other will be taxed at 22, 25 and 30%. So this is the slab rate. Okay, suppose you have an income up to 4 lakhs, slab rate is 0, you are not supposed to pay any tax. If the slab comes from 4 to 8 lakhs, your slab rate is at the 5% and you pay 20,000 of the tax. If your income is up to 12 lakhs, you come under 10% slab and your income tax come to 60,000. So 60 plus 20, 20 plus 40, it will be 60,000. This is the final figure. Then if you earn more than 20, you earn up to 24 lakhs, 12 to 24 lakhs, the slab rate increases every 6 lakhs by 15, 20 and 25. And if you earn more than 50 lakhs, your slab rate goes to 30%. I am sure most of you are in the 30% slab rate, paying flat 30%. But many of them will have more than 50 lakhs income. And once you cross 50 lakhs, you will have a tax on tax, which is called surcharge. We are not aware of this and we blindly pay this surcharge. You know, the surcharge goes on like if your income is up to 50 lakhs plus, you will have 10% surcharge. If you cross 1 CR, it will be 15% surcharge on 30%. And if you cross 2 CR, it will be 25% surcharge. Okay, so if you are in tax bracket of 30 plus, at least try to reduce surcharge, because that will reduce a lot of tax burden on you. Because I have seen many of the ITRs which they are paying surcharge as high as 20 lakhs, 40 lakhs, depending on the income. So our aim should be save the tax officially and not illegal way. Don't accumulate cash at home. That is not going to serve you the purpose because of the inflation. Your cash is getting depreciated day by day. The last classification is holding time for the capital gain. It is either a long-term capital gain or a short-term capital gain, where you hold your capital asset for more than 2 years or less than 2 years, depends on your house or anything. And for the equity, it is 1 year classification. If you hold your equity for more than 1 year, you come under long-term capital gain. And if you sell within 1 year, you will be taxed on the short-term capital gain. So how do we, there was a very nice acronym given by Ram sir in this IMP Wealthcon, that expert way to save tax. So this expert stand for expenses, person, exemption, reclassification and timing. So you have to think where you fit into this exemption and expert way and try to save the tax. The first is, suppose if you take 100 rupees, if you earn 100 rupees, and you don't spend entire year, how much tax you will pay? 30%. So how much saving you have done? 70. But that 70 is your expense. You have to pay bill, water, whatever, falana, dinka. So all expenses if you remove, at the end you will not save anything. So you have to plan in such a way that you do your expenses beforehand. These expenses are the fixed outgoing which you can't ignore. And once you do your expense, how much money you have left in your hand? 30 rupees. How much tax you will get on 30 rupees? 9. And what you have saved? Now you have saved 21 rupees. So this 21 rupees you can invest. This is a post-tax income. Our target should be increase post-tax income so that you can invest maximum. Don't spend to save tax, but save the tax on spending. So whatever is your essential spending, try to save tax on that. That is very, very important. How you can personal restructure your income? Like divide your income into multiple PAN. Now I am earning, I am in 30% tax bracket. My wife is earning, she is into 30% tax bracket. Now how I can save the tax? What I did, me and my wife started a third business as a partnership, and we have one more PAN card. So my income is divided into the third PAN. So this is a personal restructure. You can restructure your income. If you have an adult kid in the home, you can start a small business or something in his name, and you can divert your some income into his account. And this is how the personal restructuring can help you to save the tax. Exemption, there are a lot of exemption. You should study in detail about the exemption, what exemption you can have so that you can save the tax. Reclassification of the income. Like suppose you have a business income which incur the tax of 30%, you ask your CA how I can convert that into capital gain and reduce the tax liability to 20% or 12.5%, and you can save the tax. Timing. This is deferred tax to next year, okay? I mean, sometimes the big company take the advantage of this. They defer the tax in this year and they invest the amount and pay the tax in the next year. This is how you can, save the tax. So after Ram sir's expert formula, I know everybody will be happy and will be dancing like this.
دوس عندي خوش فصلة يا أخي تفوز والله خوش رقصة يا أخي دوس عندي خوش فصلة يا أخي تفوز والله خوش رقصة حلو زين مكانه حلو ديكوريشن ماله حلو.
So now what are the steps of income tax? Income classification we already discussed about Sala Bide. It's easy to remember now. So that will be their income head. Tax calculation, depending on the rate slab, rebate, surcharge, sets and interest. You calculate your tax. Payment, we are supposed to do advance payment every quarterly, TDS, self-assessment tax, and you pay. Return and compliance and tax department. The first three we have to take care because this is under your, no one will come to your rescue. Your CAs have 100 of clients and you are just one of the client for them. They cannot give their 100% attention to save your tax individually. So it will be our job to discuss with CA how can you save the tax. So first three components we have to be very aggressive and manage ourselves, and fourth and fifth you can take the help of your CA to help you out. There are various ITR forms which are available, and most of the doctors fill ITR 3 form, which is business income, and ITR 1 and other forms are for the other people, but we generally fill into ITR 3 form. The tax payment, we have to pay advance tax before every 15th of June, 15th September, 15th December and 15th March. An estimated tax, how much you are supposed to pay is 15% before June, 45% before September, 75% before December and 100% before March. I have incurred a tax interest of 1% which came to 4 lakhs, So because we didn't pay advance tax on time, or we miscalculated, and my FNO income of share market shoots so much that my CA could not calculate, and there was a interest of almost 4 lakhs. So one has to calculate every quarterly what is your income, whether for your business income, your share market income, your other source of income, and calculate and inform your CA. Don't hide from the CA, CA हर quarterly आपका नहीं देखने वाला है खोल के how much you have earned, or you will end up paying the interest. So this is how your ITR looks like. The first part is income calculation. Okay, so you calculate your income based on salary, business, capital gain, house rent, and other income, and that will give you a total gross income. You take the advantage of deduction and other, and you get the net total income. The net total income is what you will pay tax on. Okay, so if you can do any jugaad and reduce your try to reduce your taxation and invest more, you can reduce your post-tax income drastically. And this is the second part is tax calculation, So this tax calculation will come on the net total income, and on that, if you have a surcharge, rebate, you take, rebate will be taken care of, which will reduce your tax liability, and then will be calculation of the C's, tax after C's, and you pay the advance tax. Interest penalty has been discussed now, and finally tax is calculated on this part. So now coming to the Ramsar's expert way to save the tax is, if you come under the category of the salary, you try to fit that what expenses you can do, what allowances you have on salary, you calculate that. If you have a own company, you can have some personal exemption. If otherwise there is a standard deduction, National Pension Scheme and EPF, you can have exemption on this. There is a NPS deduction of 40% and EPF 12%. Max allowed is 7.5 lakhs exemption under your salary. You can take advantage of this, along with standard deduction of 75. Restructuring and timing. Timing is not possible in salaried individual. Then coming to the business and profession. In business, like us as a doctor, we have a lot of expenses to do, and if we can take that expenses under the expense heading, I think we can save a lot of tax. Depreciation is the greatest tool for the doctors to take advantage of the taxation. Personal, yes, you can divide your income, then exemption on the rent, standard deduction, and restructuring 44 ADA is very important. We'll discuss in detail, and timing. So these are the various admissible expenses. You can see depreciation. We'll take depreciation in detail. Suppose if you buy a 30 lakh car or a USG machine, okay, now Ram sir always say बापू को याद रखने का 2nd October. If you buy something before 2nd October, you get a 40% depreciation. If you buy something after 2nd October, you get 20% depreciation. So suppose now March month is coming and I'm planning to buy a USG machine or a car. If I buy in a March month, I'll get 20% depreciation within 30 days. And next year I can claim 40% depreciation. So my value, written down value will drop down to 40% because I am claiming 60% depreciation in first 370 or 380 days, you know. So that is how you can do calculation. Like in this case, you can see the actual cash saved in tax. If you are in 30% tax bracket, the first year saving is 30% on 6 lakhs, which comes to 1.8 lakhs of your tax bill. And in second year, you can save 9.6 lakh. This is on the 30 lakh value of either car or a USG machine. So in second year, you can save 2.88 lakhs. So total saving in first 2 years, it is 2 years, not 600 days, but since you have taken in March, in first 380 days, you are claiming 4.68 lakhs benefit in the taxation. So this is how you should plan your purchase also if you are eager to buy. Don't postpone it to April or May. If you can plan and finish it off before March, you can have this taxation benefit. Now 44 ADA, who all are eligible for this 44 ADA? Professional individuals and firms, but not LLP, revenue less than 50 lakhs. If you have revenue more than 75 lakhs and everything is in white, no cash component, your limit can set off to 75 lakhs. But in this, the profit declared should be more than 50%. Advantage is no audit, no books of account, ledger, journal, etc., but can keep the bills and patient's record. But this is very important for us to take advantage of this 44 ADA. You can discuss with our CA how can this be applicable to your case, and that will be helpful. Capital gain, definitely you have a exemption of 1.25 lakhs. So if you have a 2 account, husband and wife, you can book profit 1.25 lakhs every year. That means 2.5 lakhs in a family, and you can save tax on that 2.5 lakhs. So that is very, very important. A new house can save a tax. How? If you come under the 54F category, then you can save your tax. If suppose you have a capital gain tax from the shares, if you have sold your major chunk of your shares and you gave a lot of capital gain tax, you can buy a house, and that capital gain can be exempted under 44F, provided you have not more than one house at the time of sale of the old asset. There are few things you have to read the finer prints in detail, discuss with your CA, and then take the advantage of this minute detail, which can help you in save the tax. Capital gain tax, as we discussed, the exemption is 1.25 lakh per year. Hybrid fund, arbitrage fund can help you in better way than a FD to save the tax. Then capital gain in ETF and mutual fund, they are very, very important. These two sentences very important. All short-term capital gain are taxed at slab rate except equity, and all long-term capital gain are taxed at 12.5 rate except debt product. Okay, in mutual fund there is something called as a pass-through entity, which is not in FD, where you pay 30% tax on your slab rate, but you prevent in mutual fund. So finally, this is house rent property. If you let out your house to your hospital, you get a rent from the hospital, and that rent you can set off, but your rental income should not exceed 20 lakhs, or else you will invite GST. So these small things you should understand, and how you can use the advantage of this exception, PPF, SSY, gifts, and agriculture income, HUF income, and this all things you have to understand. And this is the summary of that heads of the income, where you have an income under salary, business, capital gain, and the expert formula to save the tax. So this is a summary of the entire 5 component of the expert way to save the tax. Now this will be homework for you all. You know, what is HUF. We have a detailed talk today on HUF by Dr. Vidya. Gift, how you can take advantage of gifting either to your relative spouse. There's a lot of thing in that also. Clubbing of income, 44 ADA we just saw. Loss setup. If you have a loss in the financial equity or FNO, you can carry forward to 8 years. So there are these few hidden things you have to understand and take help of your CA. So thank you very much for this opportunity.
Thank you, Dr. Nitin. I think very, very well explained taxation, giving us a thought now when we go back home. Thank you, Dr. Ram, for being with us. And I think we close this session. Thank you to all the speakers and, of course, to Dr. Riddhi.
Thank you so much. Big thank you to our fantastic speakers and our chairpersons today. I must say that the hall is jam-packed. So while we were all engrossed in listening and understanding, we had to silently keep adding chairs, and just goes to show how important this topic is. So big thank you to Nitin sir for arranging this for us. I would like to request all our speakers to please come
Let's have
forward,
Dr.
and
Sanket.
we'll have a quick felicitation.
Dr. Sanket.
I invite Zerodha sir to come on the dais for felicitation.
I think, Dr. Nitin, you did justice to the aim of your presidentship. Yeah.
Dr. Kedar, please. And this is for Nitin sir. Saving tax. And requesting felicitation for our chairpersons as well, sir. Dr. Kausha and Dr. Vidya. Nitin sir, felicitation of the chairpersons.